David, and we're back with another market update. It is 2026, and things might be changing this year for the Austin market, so we're excited to show you what we're seeing here in the stats and some anecdotes. I'm here with my partner, Lee Abraham, and we are at the Shapiro Group. If you are thinking about buying or selling this year and you have any questions, go ahead and reach out to us. We'd be happy to talk to you about your goals and what's going on in your world. Remember, you can always find us back here at the realestatevideohub.com. It's our YouTube channel, Living and Thriving in Austin, Texas. So without further ado, let's look at some stats. So here we go, looking at the number of active listings, and they are down as of the beginning of January from last month. And this, if you look here at previous years in the cycle, it's pretty standard that January is the low for inventory. And it creates an interesting dynamic, which we'll see, how much we get into that here, with buyers coming into the market in January, eager to hit their 2026 goals, renewed after a good holiday season. Maybe they got some holiday bonuses and some Christmas money from their aunt, and now they're ready to buy a house here. So moving to the next stat, Lee, you want to take this one?
Sure. So, by the way, Happy New Year, David.
Thank you.
With the active listings as we start this new year, just over 2,100 active listings, we always make sense of that by calculating a monthly housing inventory and look at the really low 30-day pending number. Typically the holidays obviously are slow for sales volume, but that's a low number. And when you divide that 462 pending sales over the last 30 days into the 2,100 plus active listings, you get a 4.61 monthly housing inventory. Interestingly, when you look at the other time frames, the number of closed sales was a surprising figure for the past months. 11, kind of a high watermark compared to what we were forecasting. Must have been some sales that have been under contract for quite some time that closed, kind of pumping that up at the end of the year. But these other indicators, 12-month average, 3-month average of around 3, are misleading. That 4.6, in spite of its flaws of low pending and low actives, is pretty much going to translate as both those numbers grow in the first quarter.
Yeah, this is surprising to me, these 3 months of inventory here. So like you're saying, this is probably more what we should be looking at.
Yeah.
And as we look at this over time, you can see that, 3, would be a huge drop off coming down to like here. Wow, that doesn't look right. So just a little bit of a anomaly with the limited number of active listings currently on the market, but we're anticipating that is going to jump up significantly here. I think what we were seeing last year, especially going into the holiday season, was people realizing like, all right, it's done for 2025. Like, we're not going to get the price we want. Let's just take it off the market. Let's wait till the new year. And what I've seen, and we saw this last year, people are conditioned to not list until March, April, May, because the highest pricing, if you look at the stats, is later in the year, is into the early summer. But that's not what we saw last year. We saw a big jump in February because you didn't have that many listings yet on the market and the buyers were starting to come out. So if you're watching this and you're thinking of selling and your team is telling you, hey, we got to wait until March to list, that is not the right advice. I don't think there's any reason why you should not be listing right away here early in the new year. We have buyers that are looking and there's just limited inventory. So you want to be out there now. You want as much exposure as possible. So if you want to chat more about your listing and how we would proceed, then reach out to us. There's all sorts of different strategies that depend on your area and the type of property. So number of sales per month. So up year over year, big jump month to month was 711. That was the number we were looking at before. So Lee, you think this is some pending sales that were pending for quite a while?
In terms of the closed sales, yes, I do. Just kind of makes sense. So with these numbers, David, it's also the first time that I can recall in recent memory where both the year over year and month to month were up. And so it's encouraging, and it kind of ties into the broader forecast of pent up demand likely being unleashed in the first quarter. And this kind of bump in the numbers, may be an early indicator that that's already started.
Yeah. Well, and we'll talk about mortgage rates and how that's impacting things because obviously that's a big driver. So I have an anecdote for you guys on that. All right. So number of sales looking good. Average sales price down year over year, up month to month. Hmm.
Yeah, I think it's a pretty solid number given last month's figure, 759 up to 821. Basically, year over year standpoint, pretty stable month to month, a nice progression as we get into January. This is going to be really interesting to see, from let's say the February to May closings. That's where it's really going to tell the story for the rest of the year, David, is once we start seeing those numbers. But this is a good, to me, initial indicator for December. If you look back, it is the second highest number for December in the past several years.
Yeah, that's pretty interesting to see that 2024 was an all-time high for December, and we're just below that slightly, just
Right.
1.3% down from that, still significantly above the prior years. And you would think that 2021 would have been your all-time high, but no, we're still quite a bit above that. So interesting to see there. I'd be also curious, maybe we should start pulling some of these stats back further so we can get some of the normal years going back to 2019. All right, this is something I pulled. I was writing our newsletter and I was thinking through, what's the biggest theme I've seen. And what I wrote out was if you had to have a thesis for the next 5 years in the Austin area in 3 words, it would be buy in Eanes. And, it's a little bit of a representative of good school districts. So you could expand that to other good school districts in the area, right? You can easily go up to some of the suburbs, northern suburbs, which have good schools, or the western suburbs. But for us, we focus a lot on Austin and Westlake, Eanes. And so that's kind of the most well known of those school districts for those people that can afford it is to be in Eanes. And so I wanted to look at some stats there. So here's the chart of median home prices in the city of Austin for, did I do single family? Yeah, for single family homes. And these charts kind of look similar with a peak here in 2021. But what's different is look at the beginning point and the end point. Ultimately, the city of Austin on the median home price is maybe down slightly, almost flat. But Ian's clearly in an uptrend. And I think this uptrend continues. When you pull the number of active listings, single family homes, it's about 2,000 for the city of Austin, only 97 in Eanes. So for those families, and maybe there's a little bit of a bias here that, I'm in that time in my life where my friends are having kids and they're starting to evaluate a lot of kids that are 3 years old right now. Hey, we're on the east side. Hey, we're in far south Austin. Where should we be living right now? And the clearer place is to go to Eanes if you can afford it. There's other neighborhoods, there's other options, but um, that is certainly the simplest because all the schools in Eanes, if you go to any of the ratings, are top rated. We're talking about 9s and 10 ratings on places like greatschools.org. The other website, if you're curious, if you want to do more research, is niche.com, also has a rating system. So those are places you should check out. And this doesn't mean you have to buy in Eanes. You might know your local area. We always talk about how real estate's hyper local. You might know your neighborhood really well and know that, hey, if we just move to this side of the block, we enter a different school district for the middle school and it's higher rated. Like those are things that you can follow as well. But I think this is just a good general sense for that everybody in the Austin area knows that Eanes is a good school district. And I think this is where you'll see better appreciation. So if you're thinking, and the reason I bring this up is we have a lot of people right now, they're like, hey, do I move into my next home where we're going to be in 3 to 5 years before the kids are in school? Or do we wait? Part of me is just like, hey, move to the better school district now. That's generally what I think. So, Lee, you have any thoughts?
Well, I'm got a couple different angles on it, so it's an interesting dynamic when you look at these graphs. The first thing that comes to mind is price elasticity. We look at average sale prices and value appreciation which are all very relevant when looking at, the return or the investment side of real estate. But there's another concept, price elasticity, which ties into scarcity as well as premium products that are free of adverse conditions and really check every box at a high level. And so I think that from a price elasticity standpoint, your thesis is sound in terms of being the place where the money's going to be, winding up ultimately. Last month we did a report on the generational wealth transition, and Austin being number one in the country. That demographic, your generation, if you will, your age group, is driving that. And so this is good sound advice, and there is a shortage. So this is a call to sellers, David, that are in another part of their life cycle. And empty nesters now at this point. Those are the folks that we'd really like to help get top dollar, given this supply demand imbalance really favoring, the Eanes school district. So it's a
Hmm.
good report.
Yeah, here's the report you mentioned that we talked about last month in more detail, just showing Austin number one millennial wealth hotspots.
Yep.
So, all right. If you have questions and specifics on this, there's a lot more to this. Go ahead and comment below if you have an experience. There's a school district that you really like, a school that you really like that you think is comparable to Eanes. We'd love to hear from you. And of course, you can always reach out with questions.
So I'll take days to sell here. They're both up a little bit, 75. We started the year at 83 and 76. So kind of, in line with the seasonality of the past year or so. Like to see this come down significantly, David. Last year, it was between March and April where we really saw a drop. And it'll be curious to see if it happens a little sooner than that.
Sales price to list price ratio. Um, Looks like it's pretty stable here, up a little bit year over year, which um, I guess is to be expected. So feels a little bit stronger than last year. So,
Nothing to see here.
all right, you want to talk about new
Yeah,
listings?
well, look at this number of new listings under 400.
Wow.
Haven't seen that. So, that's anemic to the nth degree. It might be rigor mortis. I'm not sure what the medical term or Latin translation would be, but that's a bad number. So
Hmm.
that needs to come up, and I'm confident that it will. So, wow, what else can you say?
Yeah. I don't know. Is that indicative of lots of, listings that people held back knowing, hey, it's
Yeah,
low
yeah,
and those new listings are going to hit this year?
right.
That would be my guess.
Well, that's what you mentioned earlier. So it's just kind of bearing out the point.
Hmm. And then our inventory barometer. So this is something Lee came up with. It's the most real-time stat because a lot of the indicators for real estate are trailing. This one is as close to a leading indicator as we could come up with. The 100% line is what you want to look at. Anything below, so these little sections here, that is where there is actually more sales than there are new listings. And the rest of this over the last 4 years, those are where you have more listings than sales. Here you go over the last 4 weeks. Wow, the number of new listings, like we just looked at, really low. If you go back even a little bit, it was clearly over 200 a week. Now under 100 a week, 56 in the Christmas week, of course. Surprised anybody's listing that week.
Right.
And then pending sales down as well, and you get your ratio. And then let's take a look here at what we added after we got out of the hot period is the number of withdrawns, because this really adds to the stat. Something that wasn't necessary to track when everything was selling in 2021, early
Right.
2022. But now this is more applicable as listings that don't sell and then they get withdrawn from the MLS or they expire.
Yeah, and it really is highlighted by the final week of the year down at the bottom there. If you look just at the supply demand numbers, a little bit to the left where you see the listing barometer percentage, 118.
Mhm.
If you just look at that and then one column to the right, say, hey, there were, 14 more listings at the end of the week. Well, then look at the next column, the expireds and withdrawals. It's a property dump at the end of the year. And I think it also bears out the concept of the closings that kind of jumped a little bit as well, also being in escrow for an extended period. So a lot of year end stuff. I think the market's just getting more efficient that way, David. Seasonality kind of shifting a little bit. There's more awareness of, the prices peaking and all of that from a year round standpoint. So,
Mhm.
look at all that yellow. That's a retracting inventory. And again, the takeaway for me is sellers. This is opportunity for sellers that really the time is right for them to sell in their life, in their personal situation, and there's a real shortage. And we'll take a look at interest rates, but I'm telling you, it's a lot of pent up demand. I believe is going to be unleashed here in the first quarter.
Mhm. Yeah. Um, kind of there's this gap before all the listings hit,
Right,
right? So I think that's the period we're in right now.
right.
Again, if you're a seller and you're waiting till March, you might miss the best window for selling this year, which is when there's low inventory and pent up lots of buyers starting to look. So, you want to mention anything on this chart?
Just that it's a visualization of the data. And when we see the red and the blue lines moving together in a downward direction in an otherwise healthy and essentially thriving economy of Austin, that's what pent up demand looks like right there. So pretty
Yeah.
soon that's going to be, you know, a rapid ascension over the next few months going up.
Yeah, you can look at last year. It's going to probably look pretty similar where this is 12/22 to 12/28, right? These are the same weeks. And then you're going to have demand continue up with supply, but then they come apart here and the amount of supply increases at a faster rate than the demand. And you can see that started to happen in March. So, because everybody's been conditioned, oh, you got to list in March. So, if your listing is here in this window, you're benefiting from a lack of inventory and increased demand before this spike happens. Now, hopefully, this spike looks a little bit better and keeps up with the listings a little bit better than
Yes.
last year. That would be
Yes.
my prediction if I were to draw this and we were to come
Yes.
back in 6 months and look at what this chart looks like, that we'd have pretty similar new listings. And then this red chart would just be a little bit higher than where it is this year.
Yeah. More similar to 2 years back as you
This one
look at
here.
correct.
Yeah, that would probably be a little bit. I think we'll actually see the listings be match
Yeah.
last year.
Just talking about
So,
the
but
pattern.
the demand side stays like this, and then the
Right.
new listings kind of come up here. So, this is it, people. I don't know how much I could
Yeah.
reiterate my point. So, if you're thinking of selling, reach out to us so we can get you going quickly and off to the races. So, and if you're thinking about buying, I don't think there's a rush, right? If you see the right home now, you go for it. But there could be plenty of opportunity with, more inventory later in the spring. So I think for buyers, it's, hey, be ready. You see the right home. What homes that are ready to move in, they're priced right, they're in good school districts. They have no adverse conditions, like they back up to MOPAC. Those homes, they're going to move quickly. And if you see the one that you like, you want to be ready to jump on it, especially if it's something you're going to live in for 5+ years. You're not trying to time the market perfectly and get the best deal. If you could find a similar home for, 3% less in 3 months, is it worth it, or you just want to get the home that really fits what you're looking to do? So, generally, I think for buyers, you got to make the right lifestyle decision. Although 75% of people that we work with use the word investment, and only 25% of the people are never going to live in the home, that it's a pure investment. So the majority of people want their home to be a good investment. And so, we're here to help with some of those conversations and guide you through that. That's what we do, and very well. Lee's been doing it for 40 years. Um,
Actually, 43 years.
43 years now. So, and the other advantage Lee has, he's owned an inspection company. He used to be an appraiser. He owned an appraisal company. He's been an executive at a brokerage. He's held every role in real estate, really, and so brings a vast, experience to help our clients. And those of them that have worked with him know how great that is. So,
Thank you,
appreciate you
David.
having you on the team, Lee.
Thank you.
All right, let's look at mortgage rates. So, woo, right there at the 52-week low. We are trending in the right direction on mortgage rates. And just remember, this is a snapshot that we're using to help kind of like see where mortgage rates are trending. This does not mean that's the mortgage rate you're going to get. I was with one of the lenders he worked with the other day, and he was saying that, yeah, he's quoting below 6%. That's pretty standard right now. So you can get us below a 6% loan. And a property that I'm a partner on, we're refining it and we're in the low fives right now. So there's opportunities depending on your situation. And it's I guess you know what? We're probably on an arm. That's probably why. But still, we're below this 5.44. We're in the low fives. So those are our opportunities that are out there. So, um,
You want to talk a little bit, David, about ARMs right now and maybe why that
yeah.
might be a good.
Yeah, so adjustable rate mortgages, my experience with them go back a long time. Actually, this month it'll be 20 years. I got my first adjustable rate mortgage, and it started out at 6.25 with I think it was a 5-1 arm. So meaning it adjusts for the first time after 5 years, and then it's every year after that. And interestingly, most people would refi an arm and into a 30-year fix when rates went low. But I just let it ride, and I still have that arm today. It was 7% last year, and it just adjusted down to like 6.5. It's unfortunately a small balance for me. So if it goes up to 7 versus 6.5, it changed the payment like $20 or something. So it's not that big of a deal. But in 2011, when it adjusted for the first time, we were just past the GFC, the Great Financial Crisis. Rates had been dropped significantly. So my rate dropped from 6.25 to 4.25, and eventually it was into the threes. And I rode that for years at 3%. And now it's kind of shifted its way back up. So you are, taking a little bit of a speculative play here when you go with an arm. And the bet would be that rates are going to come down. And so you'll have a chance to refi this later. Um, and I guess FRM stands for fixed rate mortgage. So this is not an arm, but adjustable rate mortgage. So, if what was going on in 2020, 2021 was that, 30-year fixed rate mortgages, the rates were so low at 3.5%. The benefit you got with going with an arm dropped like 1/8 of a point, and most people are like, yeah, I'm not going to do that. We're at all-time lows in mortgages. I'm just going to get the 30-year fixed, which was the smart play. Now we're not at those lows. We don't know if they're going to go lower. They might go high. Like, we don't really know. So it's a little bit of a speculative play to go with an arm right now. But I think for a lot of people, it probably makes sense. If you can save 0.5% right now on maybe like a 7-1 arm, or a 5-1 is maybe on the lower end, but you could go with whatever you're comfortable with. And we're happy to walk you through this. We have great lender partners that can also help you through this. So if you're not really clear on how this works and how it impacts you, again, reach out and we're happy to chat and tell you more. Um, was there anything in particular you wanted me to talk about with ARMS, Lee?
No, I just realized that it's something we've never discussed, and it's a nice nuance for people, particularly folks who are mortgage payment sensitive and they do want to get the lowest possible rate.
Mm-hmm.
And then in an environment where the forecast is for rates to, be dropping a bit, it just kind of makes sense. So, no, just thought we'd tap into your experience, Mr. Shapiro, and hear
Yeah.
from you.
It's always, I actually, it's funny. I don't even really pay attention to my adjustable rate mortgage anymore because I've had the loan for 20 years, so you can imagine I've paid it down significantly. By the way, I had a chance to do all sorts of things with this property and this loan, and I have decided to just stick it out because I want to be one of the very few people that has actually paid a 30-year loan off in 30 years. So I got another 10 years to go. It's like, all right, well, I'll just ride it till the 30-year mark. And I think I'll probably fall into such a small percentage of the population that has done that, and will have done it but at age 50, 30-year loan and by age 50. So um, yeah, I would say the adjustable rate could make sense right now. I think this is something we prefer to talk to people
Right.
individually and talk about their
Yeah.
exact situation, kind of their goals, their concerns, their disposition around risk plays a role into this. All these things are really personal. And one of the things with real estate is that every deal is different, right? Every property is unique. Every buyer, every seller, and that's why it's always helpful to have somebody with you on your side that's done this a couple hundred times and is doing it week in and week out. So we love helping people with that and walk through these decisions. Um, the way that the adjustment works, if you're curious, is it's pegged to some sort of um, an index rate. Like it used to be LIBOR for a long time. I feel like LIBOR went away and something replaced it. I'd have to look actually at what mine's pegged to these days. Usually there's like a max, like you can only go up or down 2% per year. There's usually like a lifetime max, like maybe you can only go up 4%. But these are all things that you'd want to talk to your lender and understand. And so we're happy to talk to you through all these nuances and how you can protect yourself. And is this a good arm for you, or should you just go with a fixed rate? So we can do the cost benefit analysis.
Hmm.
All right, I think it's enough on mortgage rates for today.
Yeah.
So
Good stuff.
you can always find us back here at the Real Estate Video Hub. If you got a lot out of this, please share it with a friend. Give it a like. That helps other people find us. I don't know, any closing thoughts here, Lee?
No, just excited for the new year and appreciate everybody being along with us for the ride.
Yeah, I think it's going to be a good 2026. I've had a lot of conversations about like, hey, what's going on in Austin? Like, why did we have this boom and then I don't like to use the word bust because it really didn't bust, but a little bit of a deflation. And I think we just pulled forward a lot of demand, but all of the things that made Austin so desirable are still in place. You can go down the list, and it's very hard to come up with something that really changed. I looked into the Oracle because sometimes people will say, oh, well, the Oracle headquarters moved. That's a bad sign. And when you look into it, what they're doing in Nashville sounds like it was more of a political move, and they're getting some sort of incentives but from the government there. But that facility is not going to be built out for many years, and that's not changing the number of jobs in Austin right now. And so not that was it's a decently good sized employer. Their campus makes a bigger impression than anything because it's such a prominent building on East Riverside. But hey, we still have lower cost of living than our peers. There's still jobs coming here. We still have more companies. California is trying to pass this bill that's going to be a wealth tax. And so there's more companies that are, and wealthy individuals that are entertaining Austin. If you listen to the All In podcast, the hosts there have all mentioned one of the four lives here. The other ones sound like they're all entertaining moving to Austin. Those guys have a combined net worth of $3 billion. So I think there's still a lot of positive stories that are going to drive Austin over the next 10 years. And it's a good place to invest and a good place to live, more importantly. So that's why I'm still here. All right. We look forward to chatting with you next month. If you don't get our email newsletter, we're going to start getting that out again every month. Hopefully, here's the goal for 2026. So you can sign up for it on our website. And thanks for joining us. Happy New Year.
Thanks, everybody.